Welcome to vTalkInsight, Market Drivers Daily for August 14th, 2026. Global equities are climbing again on AI-fueled earnings and very easy financial conditions, even as long-dated U.S. yields push towards cycle highs and tensions in the Middle East simmer in the background. The key question now is whether the AI capex boom can keep outrunning higher discount rates and geopolitical friction, or whether those headwinds finally start to bite. AI remains the main engine behind global equity strength and corporate capex, but the narrative is evolving. Earlier this week, the focus was squarely on how the build-out is being financed. Now we're seeing clearer proof that monetization is catching up with the hype, even as capital intensity and policy risk rise. Global equities are on track for a third straight week of gains, with renewed leadership from AI-related stocks helped by the most accommodative U.S. financial conditions in decades. OpenAI's annualized revenue has reportedly doubled to above $40 billion this year, with roughly half now coming from enterprise clients, while another leading model provider is projected to reach $100 to $120 billion in annualized revenue by 2026. In parallel, cloud and AI capital spending has surged from around $300 billion to roughly $650 billion, and cloud revenue backlogs have climbed to about $2.4 trillion, signaling multi-year demand visibility. Credit markets are deeply entwined with this expansion. AMD's record bond sale, a $14.6 billion issuance from Jane Street to fund technology infrastructure, and a multi-billion green bond for an AI data center in Oklahoma all highlight how the AI ecosystem is leaning on long-dated debt just as sovereign yields reset higher. At the same time, semiconductor and cloud companies are reporting strong earnings beats, and AI adopters in sectors like insurance are already booking sizable profitability gains, suggesting current spending is driving tangible returns, not just promises. The opportunity set is also broadening beyond a handful of mega-cap U.S. names. AI-driven productivity gains are expected to matter most where margins start from low levels, pointing toward areas such as European small caps and parts of emerging markets. Within sectors, investors are differentiating between AI-adjacent semiconductor makers with pricing power, enterprise software platforms whose complex workflows are hard to displace, and cybersecurity vendors set to benefit from a larger AI-driven attack surface. Healthcare and financials are beginning to attract more attention as they deploy AI for faster drug discovery and efficiency gains without necessarily cutting headcount. And market breadth has improved, with a clear majority of S&P names trading above their 200-day averages. Set against that, concerns are building about capital intensity, competition, and valuations. AI infrastructure projects are locking in years of heavy capex and debt issuance, and today's supply bottlenecks are delivering exceptional margins that could normalize later this decade as new chip capacity comes online. There is a risk that balance sheets absorb the cost of this build-out, just as lower-priced or open-source models, including aggressive Chinese competitors, pressure pricing power. Some observers now talk about bubble dynamics in parts of the semiconductor complex, with pullbacks after strong earnings and highly selective reactions to news from names like Applied Materials and Reddit showing how high the bar has become. Policy and election outcomes add another layer of uncertainty, with scenarios ranging from a more permissive, deregulatory stance that favors AI spending to tighter oversight of data centers and models that some analysts think could shave around 10% for broad equity indices. From here, the key watch points are AI-heavy earnings over the next quarter, the trajectory of cloud and data center capex guidance, and the timing and reception of potential IPOs from major model providers. In summary, AI continues to underpin global equity performance and earnings growth, but it now sits at the junction of credit markets, regulation, and geopolitics, which becomes even clearer when we turn to the evolving geopolitical landscape. Geopolitics remains a persistent, if unevenly priced, driver of risk premia, with the Middle East and U.S.-China relations at the center of the story. The United States is preparing what officials describe as unprecedented economic isolation measures against Iran, including a continued naval blockade and tighter restrictions on port activity, with the potential to target buyers of Iranian crude. The main transmission channel is energy and shipping. A more aggressive blockade that effectively curtails Iranian exports could push global oil prices higher, especially given already low inventories and prior disruptions near the Strait of Hormuz and in the Red Sea. Insurance premia on some routes have reportedly jumped several-fold, adding close to $1 million to individual voyages, while attacks on tankers linked to Gulf states underscore how fragile key maritime choke points remain despite efforts to build overland pipelines. Yet there is deep skepticism about how much additional pressure sanctions can realistically exert on Iranian policy. Iran's economy is already under severe strain, with domestic inflation extraordinarily high and output expected to contract, but decades of previous sanctions have not delivered meaningful policy change. Analysts highlight the risk that Tehran responds with so-called horizontal escalation, targeting infrastructure or shipping tied to countries like the United Arab Emirates, Kuwait, or Saudi Arabia, which could broaden the conflict and disrupt trade routes further. At the same time, US-China tensions are playing out through targeted trade and technology measures. Washington is imposing tariffs of up to 100% on certain foreign-made drones, particularly Chinese models, and structuring them under Trade Act investigations designed to withstand legal challenge. These steps, alongside talk of sanctions that might touch Chinese buyers of Iranian crude, signal a push toward supply chain rewiring and friendshoring, even as both sides appear keen to avoid a full-blown trade war ahead of an important summit. For markets, the result is a durable, if fluctuating, energy and supply chain risk premium. Bond markets are increasingly reacting more to energy prices and geopolitical headlines than to traditional growth signals, complicating the diversification role of duration. Oil prices have so far remained contained thanks to substitution, higher output from some producers and reserve drawdowns, and broad market volatility is still subdued outside pockets such as AI and chips, suggesting that systemic stress is not yet in play. The watch list from here includes the final shape of the U.S. isolation package on Iran, any move to penalize key Asian buyers of its crude, further incidents near Hormuz and in the Red Sea, and the tone of U.S.-China engagement as new tariffs bite. In summary, geopolitics today is less about sudden binary shocks and more about a sustained drag operating through energy, shipping, and defense budgets. That drag feeds directly into inflation expectations, fiscal deficits, and ultimately the level of long-dated yields, which have become the dominant macro variable for equities and credit. With that in mind, it is worth looking more closely at how yield dynamics are evolving. Long-dated U.S. Treasury yields sit at levels not seen in decades, and they now anchor much of the cross-asset discussion. The 30-year bond has recently auctioned around 5.2%, the highest since 2001, while the 10-year has broken out of its earlier 4 to 4.5% range toward roughly 4.7%. Consensus still looks for some further upside in the long end, but several observers argue that a large share of the term premium repricing may already be in the market, implying any additional move could be slower and more catalyst-dependent. The drivers are heavily fiscal rather than purely cyclical. The U.S. budget deficit hit a record level in July, fueled by rising Medicare costs and a double-digit increase in interest payments, and rating agencies are flagging the likelihood of a wider federal gap by 2026 given tax cuts and tariff-related rebates. The Social Security Trust Fund is projected to be exhausted early in the next decade, raising the prospect of either benefit adjustments or even more Treasury issuance. At the same time, the composition of buyers has shifted away from foreign central banks toward asset managers and domestic investors, who are demanding more compensation in the form of higher real yields. Supply pressure is clear in auction dynamics. Recent 30-year sales around 5.21% represent the highest funding cost for that tenor in roughly 25 years, and the Treasury has already sold over $600 billion of securities in a short window. Authorities have tried to lean on shorter-dated bills to ease long-end pressure, but bill shares are already near informal limits, which caps flexibility. Meanwhile, softer retail sales have pulled front-end yields down, steepening the curve as markets price a Federal Reserve on hold or modestly easier, even while longer-term inflation and growth risks keep the back end elevated. For macro and equities, elevated real yields and an unstable fiscal path pose several challenges. Rising long-term rates, driven more by deficits and heavy sovereign and corporate issuance than by break-even inflation, increase the competition for capital with private borrowers and risk crowding out smaller firms. Scenario work suggests that if 10-year yields were to rise another 50 basis points toward 5%, the 5 to 10% equity rally seen in indices, such as the S&P and NASDAQ, could be largely unwound, underlining how sensitive valuations have become to further rate moves. Some commentary points to a tilt toward inflation-linked debt over conventional treasuries and towards sovereign issuers with stronger fiscal discipline, reflecting doubts about the risk-reward trade-off in long-duration U.S. paper. There are, however, counterarguments that the worst of the repricing may be behind us for now. Investor demand for long-dated bonds is described as the strongest in more than 2 decades, even if it comes at higher yields, and U.S. financial conditions remain very easy thanks in part to equity strength and tight credit spreads. Some investors judge a forward price to earnings multiple near 20 for the S&P as still reasonable given earnings growth running close to 30%. And note that market breadth has improved beyond the core AI leaders. The balance of evidence still points to ongoing upward pressure on the long end unless there's a material positive surprise on deficits, growth, or inflation. Rising real yields are being driven not just by U.S. borrowing needs, but also by heavy corporate funding for AI and infrastructure, as highlighted by jumbo tech bond deals this week, tightening the link between the AI theme and sovereign curves. Key watch points from here include the U.S. fiscal debate into the next budget round, any policy response to the projected Social Security shortfall, the pace of corporate issuance tied to AI capex, and how equities react if 10-year yields make another run toward 5%. Together, these factors will shape whether today's AI-led equity strength can coexist with structurally higher real rates over the medium term. To wrap up, the AI boom continues to do the heavy lifting for global equities, supported by powerful revenue growth, record capex, and still easy financial conditions, but it is now tightly bound to credit markets and policy risk. Geopolitical tensions around Iran and U.S.-China trade are embedding a persistent energy and supply chain premium, feeding into inflation expectations and defense spending. And long-end U.S. yields near multi-decade highs, driven by deficits and heavy issuance, remain a central constraint for valuations and a key risk if 10-year rates push closer to 5%. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.